Hey everyone, welcome back to your Money Life podcast. We're on episode 332 of the pod. So do me a favor, wherever you're listening, make sure you like, subscribe, five-star rate and review this podcast. This week we have a decent amount to touch on, especially when it comes to the Fed's decision, the Fed interest rate decision with the new Fed chair. That's something that we definitely want to discuss, as well as some other items. What's going on in the market? The market has had more energy, has picked up a little bit this summer. So we'll just discuss that as well. Let's jump foremost into our review of this week of the market and see what's been going on in the market so far this past week. Let's see, for the YouTubers, we are going to dive into the market update right now and get a sense of what's going on here in the market. So, first and foremost, it looks like, the past week right now, the futures are showing that we should have a positive day to at least start the day. We don't know if that will hold. It's still very early in the pre-market trading. Yesterday wasn't the greatest day for the market, but again, if you look at the past month, we're about flat to a little bit higher on the market. Past 5 days, literally pretty much flat in the past 5 days. So we started out the week, fast five trading days, decently, pulled back a little bit. So, but 6 months again, still almost a 10% gain. Year to date, over 8% on the S&P 500, and past year, a strong 23% return. So again, investors have been winning, and if you've been in the market holding, buying solid assets, you have seen positive consequences from that, versus people that have not done that. And that's what we've always pushed. So if you look at this again, pulling the chart out a year, showing strong returns year to date, still strong returns. We're only halfway through the year, still much more to go. And so that's the biggest news on the front of trading. What is propelling the market right now? I think the biggest thing is you'll see is the Federal Reserve, though, did indicate the possibility of a rate hike this year. So the new Fed chair did Wednesday, Federal Reserve, with the first meeting of the Federal Reserve with Kevin Warsh at the helm of the U.S. Central Bank. At the conclusion of the meeting, the Fed kept the benchmark federal funds rate unchanged. So in this meeting, they kept the rate unchanged. They did have the dot plot, which reveals what the Fed officials see as projections for the interest rates going forward. And they now see interest rates increasing in 2026. The median estimate for the year end interest rate now stands at 3.8%, up from 3.4 in prior projections from March, suggesting that at least one rate hike could happen in 2026. What was complicating was the new Fed chair decided to abstain from submitting a rate forecast. So that's the reason why stocks took a dip yesterday. One of the reasons, I should say. So the Fed rates held the rate steady, but spoiled the mood with a much more hawkish dot plot. Elevated inflation makes that understandable. We do have elevated inflation. We noted that in last week's podcast. So that's an interesting stuff. And we know the market doesn't like change, and it's a regime change with the new Fed chair. So uncertainty with that. And that's, a big thing to watch for if we actually see a rate hike. Remember, we were showing and projecting that we'd have rates falling because inflation was actually getting cooler, but now with inflation getting hotter, they're showing a potential rate hike. So that's going to be interesting to watch as we move into next year. Let's move into actual current events so far this week. We just talked about the Fed rate. It was unanimous vote. And Kevin Warsh has inherited a hard problem. This is from the chief economist and managing director at KPMG. Inflation that has proven more stubborn than hoped, and an economy resilient enough to keep the risk of rate hikes alive. So they're pretty much saying people are still spending, although things are expensive. Think people are still spending. Inflation is still eating up budgets, wages, but there's still spending going. So that means that the Fed has to deliberate more if they can actually lower rates, or they have to keep rates elevated or increase rates. That's just something to watch for. Definitely going to affect the economy as a whole. Speaking of raising prices, Apple is actually looking to raise prices. They're looking to raise prices amid skyrocketing memory demand. So For those of us that use that product, which is like everyone, you have to get ready to pay a bit more for your Apple hardware. CEO Tim Cook tells the Wall Street Journal that price increases are unavoidable as the AI infrastructure build out squeezes the global supply of memory and storage chips, which are crucial for both data centers and consumer devices. Cook says that Apple has thus far tried to mitigate the huge increases in costs for the chips, but the situation has come unsustainable. It is not yet known which products will see price hikes. So he's pretty much saying that we have to increase prices because the AI infrastructure build out and the squeeze of global supply of memory and storage chips. And I think there was news that Apple and HP are going to band partner to build chips as well. And HP increased the stock increased on that news. So that's actually quite interesting. So we're actually seeing companies again with AI, all these different things building out infrastructure for AI. Prices are going to change in that regard as well. A little non-finance news, but Jersey Mike's overtakes Chick-fil-A in customer satisfaction. For the first time in 11 years, Chick-fil-A is not the top-rated quick service restaurant. Jersey Mike's scored 84, compared with Chick-fil-A's 83 in the annual customer satisfaction index. However, Chick-fil-A still managed to take the crown in the chicken category, while Starbucks dominated coffee and Burger King and Culver are tied for top burger chain. That's quite interesting. I have not. I'm not really a big fan of Jersey Mike's. I don't know if you guys have had it. My wife actually likes it. I just don't like it as much. And Chick-fil-A either. I'm not a big fan of that. I don't even know if I've had Chick-fil-A yet. That's how much I'm out of the loop of those two. But talking about McDonald's or something like that, Chipotle, that would be more up my speed. SpaceX shares closed down almost 5% yesterday on Wednesday, if you're listening Thursday, marking the stock's first daily decline after a record breaking few days that saw its market cap surge. So we talked about these IPOs that are coming. You have OpenAI, Anthropic, you had SpaceX, which is a huge, huge IPO. It has a 2.65 market, it has a 2.65 trillion market cap, which is bigger than Amazon. And it was briefly bigger than Microsoft as the world's fourth largest company by that metric. So we're saying that SpaceX, a company that just IPO'd, is now potentially the third or fourth largest company in the world by market cap after just IPOing a few days ago. And it had crazy increases, which again, dangerous for investors. Retail investors are going to find this and buy in at the top of this thing when it is going to cool off at some point. The valuation just doesn't make sense. We're talking about a company bigger. People have noted this is a company that was founded in 2002, so it's not like a new company per se, but it's definitely a new company that to be in public was the initial public offering the last few days. Um, the stock has jumped about 40% since its record-breaking IPO on Friday. And on Tuesday, the company also nailed down its $60 billion deal to acquire AI coding startup Cursor. Some are now suggesting that Musk could soon merge SpaceX with its automaker Tesla. So he's just merging a bunch of companies. He's just merging a bunch of. Isn't Twitter a part of this merger in SpaceX? Actually, want to look at that. But he looks to be merging a bunch of different companies together. All stock deal to buy Cursor for 60 billion. Um, man, but again, be careful with these valuations. It's going to cool down at some point. That might be a better opportunity if someone's a longer term investor. This is a longer term play. When you're talking about rockets, AI build out, this isn't a short term play for investors. It should be a longer term play. But again, you want to be smart about entry points here because it just may not make sense at where it's at right now. And let's move over to the Iran news. So there seems to be between President Trump and the Iranian president a signed memorandum of understanding, and that's aiming at developing a permanent peace deal to end the war. I feel like we signed this before. He said Trump did say he liked blaming JD Vance if the deal to end the war does not work out, but they have a memorandum of understanding, which calls for the immediate end to military actions by Israel and Lebanon and the full reopening of the Strait of Hormuz without tolls by Iran for at least 60 days. So this is supposed to be a memorandum of understanding. We don't have the full details, I don't believe. But it's supposed to reopen the strait. It's supposed to cease military fighting the combativeness for the foreseeable future. And that's a big thing. Reopen trade. Again, we said a long time ago that we saw that this would be something that happened for a while. So this is definitely still a thing that is still occurring. So, you know, that's something to note is that this is still an occurrence right now for it's still occurrence in the market. It's still something to think about in the market. Still something to think about the economy, oil prices, those things that we said would be dragging on for at least a few months. Now we're getting to the point where we think, this is right roughly where our timetable was, right? And so that's to note that this wasn't just an easy fix. It wasn't something that could go away very rather quickly. It was something that was going to shake out over months and months and still may not be finalized, ladies and gentlemen. We still may not be finalized. I think we've signed a ceasefire deal before. So we'll have to keep our eyes on it and we'll see. Let's get to personal finance questions of the day and the week. There was an interesting one. What the average American household spends on cell phone service in a year? So in a year, everyone's spending like what, at least over $100, I'm assuming. So in a year, you're gonna get to at least over 1,200, so 1,500, I would say. The answer is 1,359. So pretty close. $1,359. That is pretty close. And if you look at the chart, the cell phone expenditure from 2011 2024, it used to be under $800 when you think about 2010. And now we've skyrocketed. It's phones bills, usage, data, memory. It's all increasing, ladies and gentlemen. That's inflation, the theme of the day. Inflation, it's all increasing. Well, folks, that's a Your Money Life podcast today and this week. Make sure you like, subscribe, 5-star rating, review. We will see you next week.